Good morning. Welcome back to Market Monday. Well, good news. Chicken wing and bacon prices are going down. Yes, one of the few positives 2022 has provided, almost right on cue for football season. Chicken wing prices dropped to pre-pandemic levels.
That's not the only thing dropping. We've talked about gas prices, which appear to continue falling, but look at used car prices, also continuing that trend down from the peak at the beginning of 2022. And here's a more granular look, actually showing monthly changes going back all the way to 2008. Zooming into 2021, we see a pretty steady march higher. Then into 2022, that peak in January we just mentioned, and what appears to be a steady trend lower. Still a way to go, even to reach early 2021 prices, but a trend heading in the right direction.
Something also trending lower, housing. Housing starts. This is how many houses are just starting to be built. Site preparation, foundation, etc. 17-month low, down 8% year over year. Also, the National Association of Home Builders, NAHB, Housing Market Index fell for the 8th straight month, back below 50 for the first time since May of 2020. An index below 50 means more builders view conditions as poor than good. New home sales, these are brand new, newly built homes, also down. 6-year low, down over 50% from the 2020 high. And finally, existing home sales. These are the homes that were already built, down 20% over last year and at the lowest levels since June of 2020.
Housing is definitely taking a breather, but again, let's add some context. If I'm a news or media outlet and I want you to be on alert so you keep checking back or keep watching, I'll show you this. Housing starts are crashing. This is real data, lower for sure. But zoom out starting in 2002 and we don't get that crash sensation. Zoom out even further starting in 1985 and it looks like we're sort of at that midpoint. I'm not opining whether that's the right amount of housing starts or not, just that it may not be the crash you might hear about. Same with new home sales, the crash of 2022. Then, since 2002, perhaps on the low side, and again, since 1985. We'll see how far it goes.
Something else down, and frankly, it's been a thorn in our sides for the whole year, are bond prices. Here's the benchmark bond index, the Bloomberg US Aggregate Index, and we're looking at annual returns going back to 1976. That's almost 50 years. We see the best performance, not even close, in 1982 with a positive 32%. Before this year, 1994 was the worst performing year at down just 2.92%. There has been 5 down years, all in the low single digits. The other 40 years had positive returns. Then comes 2022, down all the way to 12.65%, bottoming, at least for now, on June 14th. As of yesterday, this index had bounced back slightly to down about 10% for the year. Remarkable.
When this type of extreme event happens, combined with inflation we haven't seen in decades, and some lingering COVID stuff, and supply chains, and the market selling off too, it's only natural to seek understanding, to look in every corner, lift up every seat cushion to try and understand what the heck is going on. This is why we have immense respect for the markets and the humility to know that it may not even be possible to understand exactly what's going on. And in fact, trying harder and harder, they say if you torture the data long enough, it will confess.
To that end, we've seen grown men and women draw lines on charts seeking to understand, drawing correlations in an attempt to figure out what the heck is going on. Here's the risk with that: spurious correlations. Here we have the divorce rate in Maine in red, trending down. That's great. versus the per capita consumption of margarine? Or how about the total revenue generated by arcades in red versus computer science doctorates awarded in the US? And one more for good measure, worldwide non-commercial space launches in red versus sociology doctorates awarded in the US. Spurious correlations indeed.
And while spurious correlations are fun to look at, the real risk is seeing something that's not there because we're so desperately trying to find meaning in these sometimes maddening markets. So we're trying to simplify our understanding, not strangle it based on some historical precedent or narrative. And as the Fed goes into its Jackson Hole extravaganza into the weekend, let's remember, number one, the Fed raising rates, look at rates today, and look at where they were in the 90s. So number one, markets can go higher with even higher rates than we have today. And number two, look at where rates peaked in the mid-90s. That's April 1995. And when did the market bottom? Back in December of 1994, 5 months earlier. So the Fed does not need to lower rates for markets to go higher.
And for today, we'll wrap with a reminder that while each year is unique in its own right, over time, certain trends warrant our attention, namely midterm election years. Let's have a look at the S&P 500 since 1931. The other three non-midterm election years in gray, sort of a steady march higher. Midterm election years tend to be grinders, down, flat, down bottoming in October before turning higher. Again, let's be aware that each year is unique and doesn't have to follow the average, but it is compelling enough over a long period of time that warrants our respect.
Thanks very much. We hope you enjoyed this video as we try to cut through some of the noise and provide some context for you. To that end, due to some travel and video production team time away, our videos will be on hiatus for the next month. Rest assured, we are here along with our service teams to continue serving you, despite not showing up in your inboxes each week. Have a great week, and we'll see you soon.